Hello everyone, my name is Duncan Hodnett and I'm Head of Global Distribution at Maple Brown Abbott. I'm joined by Dougal Maple Brown for a quick recap on the first quarter of 2021. Congratulations on another really strong quarter, Dougal.
Thanks, Duncan. In the context of an equity market that did about a bit over 4% for the quarter, to produce a return almost 9% was very, very pleasing.
Yeah, whilst around 4% return for the market wasn't particularly exceptional, there was quite a bit happening underneath the surface.
That's right, Duncan, there was. And the two key themes basically were the out-of-favour value stocks did well, the more cyclicals, at the expense of the growth and the defensive stocks. And people are calling this the reflation trade, and that was obviously beneficial for our performance. I also have to point out the quite incredible move in bond yields during the quarter. You recall last quarter of last year, bond yields backed up a little bit globally, including in this country. They went for quite a run during first quarter 2021. So big numbers, the Australian long bonds started the year at about 1% and finished the quarter at 1.8%. So it moved up 80 basis points during the quarter alone. And of course, when yields go up, prices fall. And I've read somewhere that it was the worst quarter for bond performance in something like 40 years. And again, as I've spoken about many times, bond yields, when they fall, help growth assets, and when they go up, are more beneficial for our value style.
You said last quarter that you would expect value to continue outperforming. That's come true.
It is, Duncan, and I still expect it to outperform for largely the same reasons. And that is that firstly, valuation dispersion is still very, very wide. So the expensive stocks in our view are still pretty expensive, and the value stocks, while not quite as cheap to be fair, are still pretty cheap. Secondly, in terms of what values recovered against the market and against growth, we think there's a long way to go, and I've got a chart on there in a minute. And finally, again, bond yields. As bond yields keep rising, that'll be beneficial for our style. And the first chart I've got here is the performance of value versus the market. And there's a few versions of this chart floating around. Some are value versus growth. The one I've picked here is value versus the market, and it's over a 20-year time horizon. And whilst you can see value has picked up over the last 6 months, indeed almost the last year now, in our view, and you can see from the chart quite clearly, it's quite a small blip in the decade so of underperformance. Duncan, as we analyse the performance of the out-of-favour value names over the last 6 months, we can see that the banks have had a significant role in the recovery. In addition, resource stocks have continued to benefit from positive sentiment as commodity prices have seen ongoing strength. While growth stocks have generally lagged the strength in the market, they in general have not seen significant absolute price weakness, leaving them trading still on premium PE multiples. What is particularly noteworthy is the performance of the third group of stocks, the so-called hyper-growth stocks, largely tech-related. Many of these stocks have shrugged off higher interest rates, with the stock prices moving higher and continuing to trade at eye-watering multiples, albeit off their peaks. Duncan, my final chart speaks to this valuation dispersion and particularly the 40 most expensive stocks. And I'd like to compare it to the last time that value had a good run back in 2016. As you can see, it is worth looking back to where the key industrial stocks were trading at the time of the August 2016 setback for growth. The price earnings multiple of the 40 most expensive at that date was around 27 times, whereas the multiple today still remains over 40 times, even after the current derate. This is notwithstanding the fact that 10-year bonds were trading at about 1.8% back then in 2016, the same level that they're trading today. To break this down to an individual stock level, Duncan, back in 2016, CSL, the poster child for the growth stocks, was trading a bit under 30 times, say 29 times forward earnings. Now today, again, after CSL has come back a long way, it is still trading close to 40 times. But again, long bonds are trading about 1.8% back then, as they are today.
Really interesting point on CSL, Dougal. What do you think investors have to keep in mind through the rest of 2021?
Yeah, thank you, Duncan. I still believe interest rates should be front and centre of investors' minds. In our view, they've turned decisively. They've bottomed about 80 basis points and they're now 1 point higher, about 1.8%. Instead of being a tailwind for growth, as they have for the last decade, interest rates might now be a tailwind for value. To be clear, I don't think the move in rates is going to be quite as exciting, quite as substantial as it was last quarter. And as I said, that was a multi-decade move. But I do think rates will continue to trend higher. And why do I think that? For two reasons, largely. First of all, the extraordinary amount of stimulus that governments, both here and abroad, are pumping into the economies. And secondly, the indication, indeed stated intention of monetary authorities to keep economies running hot. So they want inflation to go up, and they will not move base rates at least until inflation is seen, and that runs the risk that they lose control. And we think that going forward is a real risk. And again, when it happens, who knows? But we think rates will continue to move upwards.
Thanks for joining me, Dougal.
Pleasure, Duncan.